Hello, in this presentation we will record an adjusting entry related to unearned revenue within QuickBooks Online. We will have a comprehensive QuickBooks Online course soon, if not available yet. We also have a comprehensive Excel course which complements the QuickBooks courses and a QuickBooks Pro desktop version course you can find at the link below. Here we are in the QuickBooks Online dashboard. We will be continuing with the Get Great Guitars problem. We're doing the adjusting entries process, working in this case with the adjusting entry related to unearned revenue. In order to discuss what that is and how we will deal with it, we're first going to go to the reports down here on the left side within the reports section. Then we're going to look for the balance sheet report, selecting the balance sheet report, and then change the dates to the dates we are working on, the 2 months of February of 2021 for this particular problem, 01/01/21 to 02/28/21, January 1st, 2021 to February 28th, 2021. We are working the adjusting entries as of the end of February. That's our cutoff date. The cutoff date for adjusting entries typically being at the end of the month or the end of the year. In our case, that month being February 28th, 2021. So now we will run that report. So here is our balance sheet report. Remember, we're dealing with these adjusting journal entries, and the adjusting journal entry here in particular to the unearned revenue will be one a little bit different than our normal rules and a little bit different than the problem in most textbooks. However, something that logistically does happen in practice. So normally we say that the adjusting entry rules will have one balance sheet account, one income statement account, and cash typically will not be affected within the adjusting process. However, in this area, we're not going to have one balance sheet account and an income statement account because it's a bit different situation than what most textbooks will set up for unearned revenue. So to explain that, first we'll scroll down here to the liabilities section. Typically, a book problem will say that when we record unearned revenue, what happens is that we will have a cash that was received. In our case, we're going to say that we got money on a guitar that we have not given, meaning we got a deposit, a security deposit. So we got money before we did the work, in this case delivering the guitar, and therefore we have revenue that has not yet been earned. It's going to be earned in the future upon delivery of the guitar. And therefore we're going to debit cash or increase the cash account, and the other side, you would think, would be revenue, sales revenue of some kind. But we can't credit revenue under the revenue recognition principle because we have not yet earned it, and therefore we should credit a liability called, we could call it a deposit, or we could call it unearned revenue, for the fact that we have not yet received it yet. So we'd have this liability, meaning we would owe that money back. If we got a $300 deposit, we would owe that $300 deposit back until we finish the service and hopefully deliver the guitar, and then we're not going to give the $300 deposit back. It'll be part of revenue, and then we can record that as a revenue account, or debiting or decreasing the liability, and crediting or increasing the revenue account at the point in time that we record the invoice. So that's how, in a book problem, then the adjusting entry would be the question as to how much of that unearned revenue has now been earned, and therefore should be reduced, the liability reduced, and the revenue increased for that amount that has been earned. Our problem here is going to be a little bit different in that what we did is we're, from a logistical standpoint, we're saying, yeah, if I put the liability down here in unearned revenue, it's not going to be controlled under the receivable accounts. And the receivable accounts are where we have our detail in terms of the customers. So even though this is really kind of a payable or a liability, we would really rather track it along with all the other receivables, which is tracked up here in the accounts receivable, because doing that allows us to match out and run reports by customer to see invoices matched out to deposits and payments. Whereas if we record the deposit in a liability account, it becomes more difficult to run like a customer report and see that matching process. So one way to deal with that, just from a logistical standpoint, which isn't exactly proper and something we would then of course need to adjust for at this time, is basically debit cash when we get the revenue, and credit accounts receivable account here, which really doesn't make sense from a accrual basis because it makes a negative receivable. So that would be what would happen here. We got a negative receivable. Now, if you look at this accounts receivable, you're going to say, well, that's not a negative receivable. It's a positive 10,974. That's what people owe us. And that's true, but there could be some amounts in there that actually represent deposits that we haven't earned, like deposits that we owe back. And to figure that out, to find out if there's anything in that amount that's really a negative accounts receivable or should be a liability, we can run the customer detailed report, which basically shows the same number by who owes us that money. So here's what is owed to us by customer. Let's see who owes us that money and break this out. So we're going to go to reports on the left side, and we're looking for something like a customer balance detail. So here we have it here, the customer balance detail report. That's the one we want, so we will run that. So here we have it. So now we're going to adjust the dates up top. So we're going to look at all dates. We're going to look at the custom date range, and this is an as of report, so we only really need one date, and we're going to make it as of 02/28/21. If we don't, it gets the most current data, and we included one invoice in our data that was past the cutoff date, but we really want to see it as of the cutoff date because there could be activity, of course, past the cutoff date in any particular problem. So 2/28/21, the cutoff date. If we scroll all the way down, then we get the 10,974. That should be what we just saw on the balance sheet. Now what we want to do is go through there and see if there's any kind of balances that look kind of funny, meaning they're negative balance. A negative receivable would really be a liability account. It'd be kind of in here backwards. So this would be 600. So that means that they owe us 600. This is Jeannie Jones owes us 1,050. This customer Jill owes us 1,350. If we keep going through this, these all look like normal balances, except of course this item here. It's a negative, and there's nothing else matching it out. All we have is this payment standing alone. And what we typically would see is an invoice and then the payment matching it out to close out that invoice to match it up with. And it's not typical that we have a $300 payment with no invoice and therefore have this negative amount. So the total then, of course, still represents the fact that people owe us money. People owe us $10,974, but really it should be $300 higher, because it's being reduced by this kind of negative receivable, which should not be a receivable, but really should be unearned revenue. So once again, why put that in there? Well, once we actually do the work, once we deliver the guitar, then we can make the invoice after we make the payment and match it up to this deposit, and everything will be great and we'll be able to track that here, and we won't have that problem anymore at that point in time. However, the fact that this happened right at the cutoff date means that we have this issue, and it's not quite right at the cutoff date. If we delivered the guitar before the cutoff date, as we have in some of these other unearned, when we had deposits on guitars in the past, it would have solved itself. The timing difference would have been dealt with within the time frame, and we wouldn't have a problem. But because this had not yet cleared, had not yet finished, and it's the cutoff date, we have this issue here. So to be proper, we need to take this out of this account, meaning we need to increase the amount people owe us, increase the accounts receivable, and record it as a liability like a deposit or an unearned revenue. If we look at this payment, if we just click on this payment and see if we recall entering this information, we have a received payment amount here, and it's for music store stuff, and you'll note that typically when we have a received payment, we have the 300, we have an invoice we check off, and we have no invoice here because it was a deposit. So what we're going to do now is make this adjustment. So I'm going to close this out. Normally to make an adjustment, we would go to this little plus icon up top, and we would go to journal entry, because it is an adjusting journal entry for the most part, even though it's a bit unusual compared to some of the others that we've had, in that there's not one balance sheet account, one income statement account, but two balance sheet accounts. We're going to first take a look at the chart of accounts, and we're going to add the new account, that account being unearned revenue that will be needed in this journal entry within the chart of accounts, and then we'll come back here and we will enter this journal entry. Note that we've used registers for a couple of these in the past. However, we're not going to use the register here because we're dealing with the accounts receivable, and we need some added information, typically the customer, to make that work, and that kind of makes the register a little bit more difficult to use, even though we only have the two accounts here. So even though we only have the 2 accounts, we're going to be basically recording it here in the journal entry rather than using the registers. So I'm going to close this bag out. We're going to go to the registers, which will be under the accounting. And we want to be under the chart of accounts up top. The accounts will be in order by type. So the other account's going to be unearned revenue. Remember, it's going to be a liability type of account. So we're going to say we want a new up top. And then we're going to put in the type of account. And we're going to say that it's going to be an other current liability type of account. See if what kind of detailed accounts we have for the other current liability. I think it's just going to be other current liabilities, but let's just check and see if there's anything better. We're sticking with other current liabilities here. And then we're going to change the account name and we're going to call it unearned revenue. Unearned revenue. There won't be any subscription. It's not going to be a sub account of anything else. So we're just going to save that item, save and close. Now we're back at the chart of accounts, accounting chart of accounts. And note that we were going to do this by the registers. We had the registers over here and we could enter a lot of transactions with the register. It's a little bit more difficult even though there's only 2 accounts affected here to use this register because the accounts receivable makes it a little bit more difficult. The accounts receivable register, because it uses customers, needs to have a little bit more information to make sure that when we enter information into the accounts receivable, it will be recorded not only in the GL account but will be recorded in all other accounts and need the customers. So the register here is a little bit different. We could also use the unearned revenue register, which is the one we just made because they're both balance sheet accounts. So here's the new account we just made. It's got the 0 balance. It's got a register here. But again, because of that added complexity, we're just going to go down to the default, which is typically the way journal entries or adjusting entries will be made. And that's just with a journal entry. So we're going to go up top and enter. We're going to deal with the debits and credits here. It's not too bad. There's only 2 accounts. So whether you like debits and credits or not, that's the pros and cons will be using debits and credits and learning those processes. And this is typically the way the adjusting entries will be put in place. So we're going to go to the plus item. We're going to go to journal entry. And we're entering the debits and the credits. Now what we're trying to do is increase the accounts receivable by the 300 because it had a negative receivable. Accounts receivable is an asset account. Assets have debit balances and we need to make it go up. The way you make something go up is you do the same thing to it as its normal balance. That's how I typically go through this process at least. And therefore the accounts receivable needs to be debited to make it increase. So I'm going to choose accounts receivable. And here it is, accounts receivable, and we're going to debit that for $300. We're going to put in the memo that it is an adjusting entry. Or let's see if I can type. And then we do need a name here. We got to have a customer or else accounts receivable will not be able to record this. QuickBooks will say, I can't record to accounts receivable until you tell me who owes us that $300. And remember, we had the customer here, which was string music. So we're going to type in string music. You can select the drop down and find it and or type in string music. The other side is going to be the new account that we set up, that account of unearned revenue. Once again, we can select the drop down and or type in unearned revenue. There it is. It's an other current liability type of account. We already know that we're going to credit it and it automatically puts the credit in there because we debited the accounts receivable. But if we think through that, let's think through it and say, does that make sense? Unearned revenue, liability account. The liability is going up because we owe somebody this $300 even though they're a customer because they gave us money. We haven't given them anything yet. We owe them either the $300 or the guitar. Therefore, the liability needs to go up. Liabilities have a credit balance. We need to make something go up by doing the same thing to it as its normal balance, which in this case, the credit balance would mean that we do the same thing of another credit to increase it. So that'd be the transaction. Now again, it's a short transaction. There's only 2 journal entries, so if you went the wrong way with it, then you just need to go back in here and do the opposite. Meaning, if we had credited the receivable and debited the unearned revenue, then and it went the wrong way, and we had then we'd go back here and just change it after we're done. So we're gonna say, and by the way, obviously accounting software like QuickBooks allows you to change things. Other software which would be more proper not to allow you to change things, we'd actually have to reverse it with 2 entries. We'd have to have a reversing of the error entry and then have a new entry. But QuickBooks will allow us to make changes, whether you approve of that or not. It does, and so you could go back in here and fix that typically. Now before recording this, we're going to go up to the date up here, which we probably should have done at the beginning. This should all be done as of the end of the month. So our month, the cutoff being 02/28/21. So that's the end of February 2021. So we're going to go ahead and save this and then take a look at our reports. So we'll save that item. We'll close that item. Then we're going to go to the reports, which is going to be on the left side. So we're looking at reports on the left. We're going to look at the balance sheet here, and we're going to change our dates to the current time period that we are working on, which is 01/01/21/02/28/21, January 1st, 2021 to February 28th, 2021. Then we will run that report, and we're looking at the two accounts affected. One will be the accounts receivable account. Let's drill down on that, take a look at it, selecting that item, scrolling down, we should see an adjusting journal entry. It's number 10 here, I believe, for the $300. That's the one, that's the one. So we're gonna select the one, 300, and that should take us back to our journal entry. There it is. Closing this back out, what did that 300 do? It increased our balance here. So it increased our accounts receivable balance. We believe that makes sense. It might make more sense when we take a look at the accounts receivable by customer, the customer balance detail, in other words. Let's scroll back up and take a look at the other side. We're going to go back to the report, back to the balance sheet. Scroll down to the other side, which is the new account we set up, that account of unearned revenue. Unearned revenue. So we set that up in the other current liabilities section. Here it is, unearned revenue. There's the $300 in it, so it increased the liability, meaning we now owe this money back. Now, again, that might sound funny because we're talking about a customer here, and we're like, we don't owe the customer money, they give us money. But remember, they gave us money before we did the service, in this case, gave them the guitar. They gave us the deposit. So we really owe that money back in a similar way that if it was a rental property or something, then the deposit would be something that would be returned at the end, or theoretically should be. And then here we have this item. If we select it, then we then see our $300 journal entry once again. Let's take a look at that one other report, which is the customer balance detail, and see what it looks like on the customer balance detail. So we're going to go to the reports on the left side. We're going to check out that customer balance detail, which is right there. If it's not there for you, go ahead and type in customer balance detail, and we will run that report. And we're going to run it by the date. We really should. It's going to be as of the end of the time period, all dates basically, but we really should run it as of the cutoff date, which is 02/28/21, and then run that report. And as we do that, if we scroll down, we should be matching down here. Here's our 11,274. Here's the 300 that we had that was like a negative asset account. And then here's the 300 that was a journal entry that basically nullifies that. It increased the total balance, and it says that it matched out this amount here. And so we're correct now as of the financial statement date. This is to where it should be. It's been increased by the 300, and we created what should have really been there, which is a liability. Now note, however, that you might be saying, well, that's all well and good right now, but now what's going to happen, later on when you actually have the invoice? And so we have two different objectives here. One's the accounting department, the adjusting department's objective to make the financial statements right as of the cutoff date, which we've done. But unless we do something else, or unless something else happens, we've kind of messed up the normal logistical process, which was working fine, except for this kind of issue at the end here. And in order to fix that, we're going to do reversing entries. Not a perfect process, but a process that kind of works logistically to separate those two goals. And we can have two different processes working to do two different things, and two sets of people working those different processes by using the reversing entries, which will in essence just reverse what we did here as of the first day of the next month, which will be the first day of March in our case.